record it. Oh, there we go. We're recording.
Are we live?
Welcome. We are live, folks. Hello. It is just after noon on Wednesday. Ari, Joe, and myself, Josh Kanan, the partners of Premier Wealth Advisors, and we've got a fun webinar in store, hopefully, for you today. Ari, kick off the intro, my friend. Hopefully, you guys can see our screen, which should be say want to invest like Buffett.
Yes. So I'm from home today, so I'll apologize in advance in case there's any barking dogs running around behind me or anything else. So welcome everyone. A couple quick housekeeping things before we get started on stuff here. There's an attendee chat function. It's on the left side of your screen. That is a good place to, if you want to ask a question or send a message, feel free to use that. And then on the right side of your screen, you'll see a little box that has up on the right-hand corner in the blue area. If you click on that, this will go full screen on your browser. So if the slides are too small or you want to go full screen, just hit that button. So, so today this is, I don't know what number webinar this is for the year, but we've been doing these now for a few years, and we always get good feedback. And we thought we'd kind of bring it back to the basics and, kind of go through the Oracle of Omaha's tenets, if you will. Most everyone on here knows us. My name's Ari Crandall, and Josh Kanan and Joe LeBlanc are with us as well. We are managing partners and founders of Premier Wealth Advisors. And Premier Wealth Advisors is a full-service financial planning, investment advisory, and income tax firm. We have a very simplified process that we put most of our clients through. We call it Design, Build, and Protect. And it is a way for us to make sure that our recommendations are in alignment with our clients' goals and objectives. Most of our clients come to us with some questions, and what we try to do is just understand their situation, identify what's going on in their lives, take a look at what they currently have in place, put together some recommendations, help them implement them, and monitor them on a regular basis. We have a 360 financial solutions map that we've developed, and this kind of gives a good overview of all the different reasons people usually reach out to us, or the different things that we can help with. Sometimes it's, hey, I just want to live a simpler life. Sometimes it's, tax planning. Sometimes it's wills and trusts and reviewing those items. Today, we're focusing on the center section of the 360 financial solutions map under creating financial comfort, simplifying finances, reducing taxes, and protecting assets. So with that, I'll hand it over to Josh. And Josh, maybe you can walk us through what we're going to go through today.
Absolutely, Ari. And I heard that before I get into this, that the surf was really good today. Is that a true statement?
It's a very true statement. That's partially one of the reasons I'm working from home, because I had to do that this morning, and I'm probably going to go do that this afternoon. So I will admittingly say I'm selfish in that regard, and I will do whatever I can, because that is a finite resource. It's not like the golf course that's always there.
Well, one of my enjoyable things is playing basketball, and I played a full court 5-on-5 pickup game this morning for the first time in 18 months.
Nice.
So that was nice to get back out there.
Yeah.
Now you're making me look like a slacker because I just came to work.
Yeah. Someone just sent a message. They said 100%. My hair is still salty from the ocean. So there we go. All right, let's get into it. I know we're on a tight schedule today.
All right. So Warren Buffett, the Oracle of Omaha, and we thought we'd try to make this kind of a fun presentation today. And we're going to try to answer these three questions and get that advice from Mr. Buffett himself. We wish he would be joining us, but that's not quite the case. But we're going to answer the question: should you use active or passive funds? We're going to find out, should you pay attention to all those prognosticators and market forecasters that talk about where things are headed? And then lastly, we'll try to answer, should you try to engage in market timing? We'll get, Buffett's take on each of these things. I want to first describe, real quick, the difference between active and passive, just, quickly. Active means you're trying to beat the market or trying to find some inefficiencies so you can outperform everybody else, where passive just means that you're trying to capture market rates of return or asset class rates of return. And then on the market forecast, obviously, every year you've got hundreds of prognosticators trying to figure out where things are headed. And then market timing means trying to get in and out at the right times.
Yeah.
So in terms of, I'm going to start by letting you guys take a look at 3 quotes from Mr. Buffett over the years that can provide a good clue to question number 1 as to which approach he recommends regarding active and passive. And so I'll just kind of flip through these quotes first.
What's interesting is the year that these quotes were made.
Yeah,
they're still relevant. They're timeless, right?
They're absolutely timeless, and
they're during the 90s .com explosion.
Yeah.
And then just after the .com explosion.
Yeah.
Right. So you've got obviously, lots of different time frames. And even if you saw some of his more recent quotes, the message remains pretty, consistent in the sense that, trying to ultimately capture what markets provide you. And you guys know this, the market rate of return in a particular asset class is actually pretty good over time. If you just look at the broad US stock market going back 100 years, you're looking at almost a 10% annualized return just by capturing what the market gives you. And so I think a lot of what Mr. Buffett believes is that, in his last little quote, sentence there, instead, many investors have had experiences ranging from mediocre to disastrous. And we're going to get to that a little bit further in our presentation as to why they get those types of experiences. But I want to start by passing it over to Joe, Professor Joe, on why this tends to be the cause and why Mr. Buffett believes that the more passive or at capturing the returns of the market is the better approach.
There's 3 primary causes for what we see as underperformance of an investor versus the market. The first one is high costs, simply because people are trading too frequently and they're trying to maneuver, which has a cost in the market. The second one is looking at decision based on tips and fads. So people, again, trying to latch on to all the different theories, the dogs of the Dow, whatever you want to call it. The meme stocks is kind of the newest one. Looking at things that are fad based or trends, and those don't typically hold up over time. And then lastly, having a start and stop approach, and that is the trying to time the market. So most people tend to underperform because of these 3 things. And so, Buffett would say that, excitement and expenses are your enemies, and you want to try to, temper those down and, kind of go with the flow and let the market do the work.
Yeah, I mean, go ahead, Ar.
No, go ahead.
I was going to say the decisions based on tips and fads is so relevant this year, right? With, like you said, you got the meme stocks, you've got, in a sense, at the beginning of, kind of the recovery from the pandemic, the stock market shot back up, and, all those folks that, were the Robinhood traders, they called them, or the ones that were on some of these chat rooms, were basically could throw a dart at something and it would start to really perform. And we know realistically that over long periods of time, that's not necessarily the best approach, is to just go to a chat room and figure out what the best stock is to buy right this moment. So being careful of the noise is very important.
It might be exciting, and maybe that, fills some need in your life, right? But
we'll get to that later.
Yeah. But just because it's exciting doesn't mean it's good. So sometimes boring's okay, right?
Exactly. And then, so, just to kind of play off of all of that, the next thing is looking essentially how Buffett feels about, forecasting and, what all the prognosticators are putting out there. And, Josh said hundreds, is probably thousands of market commentary every single day that you could read and spend your time on. But let's see what, Buffett has to say about that.
Yeah, this is pretty interesting, So we've long felt the value of stock forecasters is to make fortune tellers look good, right? And they continue to believe short-term market forecasts are poison and should be kept locked up in a safe place away from children and grown-ups that behave in the market like children. Pretty funny quote, so we'll let you guys read the next few.
Oops.
There was another.
So I guess the one question, Ari, that I would ask you on this particular, forecasting situation is, why do investors tend to kind of ignore all the evidence out there and even Buffett's advice and continue to pay attention to these prognosticators? I mean, every year, like clockwork, every big bank comes out with their S&P 500 forecast, or the market's going to do this, or the market's going to do that. And the evidence is crystal clear that in most of these cases, they're a lot of times way off on their forecasts, but no matter what, people go after it.
It's called the smartest guy in the room theory. And that is, everybody thinks somebody else is the smartest guy in the room, when in reality, the smartest guy in the room is the collective, and that's the market. So all the market knowledge together is 90-something% of the time smarter than the smartest prognosticator. Very few of them actually have valid forecasts that hold up over a long period of time.
I think there's also just an innate human behavior or trait where there's this need to believe that someone can protect us from bad things happening, and whoever has the most convincing story is going to be that person, or whoever has the most conviction in their message is going to be able to do that. And oftentimes, as when we sit down with clients, sometimes they don't know what questions to ask, and it's a lack of education as well around what makes common fundamental sense on portfolio design.
So Ari, I think the next time that everybody who's listening is tempted to act based on some of these forecasts, they should ask themselves these questions that I'd like you to kind of go through.
Sure. So the first one's pretty easy, right? Is Warren Buffett acting on this expert's opinion? I mean, he's
probably not.
Probably no.
Right? And if he's not, do you think he should be?
Again, probably not.
Right. And then what do I know that Buffett doesn't? Because, he's regarded as probably the smartest guy in the room, in every room he walks into when it comes to this topic. Right. And a lot of times people want to make a change. So if you do make the change and you're right, is it going to have a good impact on your life or not? Does it matter? More importantly, I always flip that the other way around, and I say, if I guess wrong, what's it going to do?
Right. I think that goes big time on, thinking back to last year, right? You had the March 20, February, March time frame. You have the pandemic hits, market drops 33% in 16 trading days. And so in a situation like that, if you, don't make a change and do anything, how does it impact you? But what if you make a change, like pulling out and going to cash, and then didn't get back in?
We talked so many clients off the cliff during that period. There were dozens of phone calls of what should we do, and it's interesting when the stock market, when things are on sale, usually people buy more of them, right? When you're at the store and it's like buy one, get one half off, most people will take that offer, right? When the greatest companies in the world are 30% off, what are people doing? They're like, oh, we got to get rid of them. And, we told some clients, are you sitting on cash? It might be a good time. This is kind of one of those opportunities where you're going to look back and go, man, I wish I had more of it so I can buy more. Right.
And the other point that Ari's, usually says is, if you, choose to get out when that market drops, you have to be right twice.
Yep.
So not only did you have to make the decision to get out, you have to make the decision to get back in. And, to Josh's point, that tends to be the problem, is the fear sets in at that point, the fear of being wrong again, and you wait too long to get back in.
Yeah, oftentimes it's easy to feel good about the decision to get out of the market. But like I say, you got to guess right twice. You got to guess right when to get back in as well. So.
And the last question there.
have I been wrong before? I think we kind of covered that one, right? So,
so we just started talking about market timing, right?
Yeah,
And
yeah, exactly.
so let's kind of dive into what Buffett thinks about market timing. First quote I'd love: "Our favorite holding period is forever." He tends to own stocks very long periods of time through thick and thin. Money's moved from the active to the patient. Love that quote.
Something Joe mentioned in one of our webinars, prior webinars, is if you really think about it, if you're selling a stock, someone is buying it.
Exactly. Right? There's two sides to every trade.
Exactly.
Yeah. And the tendency, and I think this is a lot to do with just the industry in general, the Wall Street mentality, the feeling that you should be always doing something. If you're not, doing something, then you're not, why are we investing? We should be, acting on this news. And that tends to be the message that Wall Street wants to push out there. But to Buffett's point, most of the time, the more active you are, the more maneuvering you're doing, you're basically causing friction, cost, as Joe mentioned earlier, and ultimately not capturing that rate of return that's available to you at whatever particular asset class you're investing in. And so I think that's a big part of it. And too often we run into folks that are feeling like we need to be doing more and doing more. And as we're going to get to later on in the conversation, there's a kind of a happy level of activity that needs to happen, right? Like kind of a good level, and that's usually within the rebalancing that takes place within a portfolio on set systematic basis.
Yeah.
I think this next cartoon really kind of starts to spell it out. And Carl Richards, guys, as you know, has been in our industry a very long time. They call him the sketch guy. He used to write for the New York Times. He's got all kinds of really good, simple sketches. But this one's one of my very favorites that tends to really talk about the roller coaster ride of emotions that happens when we invest money. And, we tend to, the average investor tends to wait until the market gets to the point where it's, at all-time highs. And then they start to really overload or buy performance, right? They'll chase the hottest stocks or chase the hottest sectors at the most inopportune time. Then they watch it fall all the way down to the point where they're the most scared out of their minds. And then that's when they sell. And I think I love the part at the end there. Just repeat that process consistently and you'll be basically broke.
Yeah.
And so, what rebalancing does, or what the proper behavior would be, is to do the exact opposite, right? In terms of, when an asset class gets to that point where you're feeling that greed, it's probably the best time to pare some profits off of that. And when you're so scared out of your mind on a particular asset class or an investment, that's probably the best time to be buying. And what tends to happen is Carl Richards points out in this particular sketch, is that you end up a statistic that he calls the behavior gap. And this has been, a study that goes back, I can't tell you, as long as I've been around in this business, decades. And it's a company by the name of Dalbar does this study every year. And it shows kind of what the investment return is of the S&P 500 over the last 20 years. And then it shows the average investor in an S&P 500 fund. And you can see that they're not getting or capturing that rate of return that's available to them throughout that time frame. And it's because they don't stick to the plan the entire time, or they don't stick with the investment the entire time. And the great irony in all of this is that, why all these investors out there that talk about Buffett and how great Buffett is and idolize Buffett, very few actually listen to the advice that he provides.
No, it's, yeah, one of the great things out of that Dalbar study is, they basically pared it down to a simple phrase. The greatest determinant of investor success is investor behavior. I mean, those two intricately linked, right?
So that's I think it's within those periods of slides, I think we're pretty clear on Buffett's advice regarding market timing. Not a big believer of it. But Joe, let's look back at the financial crisis and Great Recession kind of 08, 09, and what happened then as it relates to kind of this advice.
Yeah, that's everybody wants to invest like Buffett, but very few do. And we're not talking about the metrics that he uses to select companies that he wants to buy, but simply kind of his overall philosophy, which is as you pointed out in a bunch of those quotes, buy and hold, let the market do the work. And so if we look back to the financial crisis of 2008, the Great Recession, what we saw is exactly that last slide showed, that investor gap. The investor behavior was to pull money out of stocks, out of mutual funds as the market was declining, rather than putting money back in. And Buffett, for instance, was doing exactly the opposite in Berkshire Hathaway. He's putting money back in.
Yep.
Now, obviously, a lot of stuff happened in 2008 in the economy, in the stock market, but the people that invested either on the way down or at the bottom were the ones that made out, because they participated in the recovery of the stock market that eventually came. If we look at another example is Brexit in 2011, a whole crisis in Europe that was self-created as England, the UK left the euro. A lot of prognosticators were thinking the market was going to tank, and in fact it didn't. And so again, people were pulling money out of the market at a time when there was only fear in the market, and the market really didn't dump. And Berkshire was investing at that time and buying big good companies on sale.
Yeah, I remember that clearly. It was like no one wanted to mess with Europe. Europe's a mess. Why would I want to have anything in international?
Yeah.
And at that particular time, that's when when that fear's that high, that's a great signal to me right there that that must be a good buying opportunity. And I think Buffett seems the same way. I think it was one of the biggest injections that he had in that international market in decades.
Yes.
And similar to what happened in 0809. Where, and I think in 0809, it was the banking crisis, right? And he actually had made a big investment in Wells Fargo when it was basically, on the verge of bankruptcy.
When it was a fire sale, exactly,
right
at that point. And so, then Buffett admonishes against market timing. So, be fearful when others are fearful, you want to buy, and you want to sell when others are greedy. So again, going back to that roller coaster, you want to buy at the bottom and sell at the top. So kind of do the counterintuitive. And then, don't sell when valuations are low. So when the market does have a dislocation, which occurs every, 5 to 7 years on average, the market has a 20 to 30% decline. You just have to expect that as an investor. That's the time to buy, not the time to sell. And then lastly, Buffett is always buying at these times because that's when expected returns are actually higher. If you look at, in the industry, we call it the capital asset pricing model, looking at the cost of investing or the return of investing. And the higher the price is of a stock, the less expected return going forward. And so when the stock price declines or has a temporary, setback, the expected return over the next period actually is higher. And so that, kind of a geeky math concept, but, buy low, sell high is the, the easy math on that.
And I love his last quote there.
Yep. Whether it's stocks or stocks, buy, as, Ari pointed out, the stock market is, one of the few things that people don't buy when it's on sale. But Buffett, has the wisdom to do that.
So we got one question from a attendee around, to what extent do we preserve cash to take advantage of opportunities in the portfolio? And it's very situationally specific. Are you in an accumulation mode? Did you just move over, a big chunk of money, and, are we investing it on a regular basis? Are you taking distributions? So everyone's portfolios are a little bit different because they're customized based on the client's situation. But one of the ways that we do take advantage, we're going to get into, I think, on the next slide regarding, kind of some of the core tenets around, a sound investment plan, right? You have to have discipline, first off. and ignore your emotions and adhere to your investment plan, which requires that you regularly rebalance. Rebalancing is one of the greatest gifts in investment theory that's out there, because effectively what you do is, you're buying things that are low.
Buy low, sell high.
Yeah, I mean, it's basic. You're taking chips off the table, in an up market, and looking at areas that aren't doing as well, and capitalizing on those opportunities through rebalancing. So it's pretty amazing when you do the math and the regression analysis on these portfolios over time, and you look at the impact that rebalancing has, not only on the overall return, but on keeping the risk profile in alignment with the client's goals. And this is the stuff that, as advisors, I always say we geek out on this stuff on the back end, and the clients don't really get that transparency. But we're looking at all these things and going, "Oh my God, what a great opportunity!" That's out there for clients. So
right.
And I would just address
back to that question. We don't really believe in preserving cash on the sidelines to wait for an opportunity. We really believe that being invested to your risk tolerance is always the appropriate thing to do. But if new money is coming in, that's the point where we're rebalancing, and we're naturally buying more of the things that have gone down relative to the other parts of the portfolio. And so, that rebalancing could be cash flow based, so deposits and withdrawals. Typically, we're looking at it quarterly, and then, certainly annually.
Yeah.
But the mantra is look often, trade infrequently.
Yep.
So look frequently to find, big changes between the asset classes, but don't trade frequently, because that just adds cost.
And let me add to the answer to the question as well, Joe, in the sense that, partly your fixed income or bond allocation, in a sense, is kind of like your cash on the sidelines, so to speak. I mean, in our philosophy, as many of the listeners know, we believe that bonds are there to be a shock absorber in your portfolio, not to be necessarily a big return producer. So we're not taking a lot of risk in the bond side. And so, you typically are going to have very short duration bonds. You're going to have high quality bonds, and they're not going to fluctuate as much as maybe some riskier type bond strategies. Now, with that being said, in a time like last year, you had February, March hits, the market takes a big hit. On the bond side of your portfolio, that's in a sense your dry powder. It's rebalancing, yes, Joe, but in that opportunity, you're saying, okay, now if I had let's call it a 60 stock, 40 bond portfolio, and the market takes a crunch like that, you're no longer 60-40. And so maybe you're down to 50-50. And so on that opportunity, you don't want to have that much a percentage in bonds. And so you take some of those bonds and buy those stocks while they're on sale. And that is how you're using the dry powder, or the money, so to speak, on the sidelines. That's the best way to take advantage of the opportunities that present themselves when markets correct them. And I think, look at it that way. Even someone like myself, who, I tend to invest very aggressively. Some have even asked me, why aren't you just 100% in stocks, Josh, since the market's well, and that obviously, you don't need to have a lot of bonds if you're not retiring for many years. And I say, because I always want to have a little dry powder for the opportunity.
Yeah. And I remember some of those gut check calls with clients in 2008, early 2009 of, hey, the market is down. Things are horrible. Your bond, portion of your portfolio relatively is much bigger than it should be. Let's, sell some of those bonds and buy stocks at a time when things are really gloomy. And, most of the clients are like, yeah, let's do it. That's, what we need you to do. Occasionally some people were taken by the fear.
Yep.
So we're going to turn to 4 important insights that can kind of help you become more Buffett-like in your approach to investing. I like this, the diagram that's on there right now. I mean, this is basically the difference between, having a successful investment experience and not so successful investment experience. Much of the concepts we've already covered. But let's talk about, this first one is going to talk to us about, or kind of talk a little bit about how we understand and think about bad news. And, when we think about bad news, initially, and it goes back to last year too, right? When we think about bad news, we immediately think that the stock market's going to crash. And it doesn't necessarily mean that stock prices have to go lower. Because what we know, guys, is that we believe that markets are pretty darn efficient, right? Which says that, everything, all the 24/7 news that's out there is properly reflected in today's stock prices. And so the bigger issue becomes when news is worse or better than what we might have originally anticipated or expected. And, failing to understand this, real basic tenet causes investors to react to the news, and they get over enthusiastic when news is good. And then they get very panicky when news is not so good. And so if you can understand this part well, you can be a lot more like Buffett. And Joe, I want you to kind of take it from there to kind of explain it a little bit deeper.
Right. And that's, as you just mentioned, Josh, one of the things we believe is the stock market always incorporates all the information that's available. And it's the surprises that, move the market differently. And so, we have to continue to think that when there's bad news, the markets will continue to fall only if the future news is worse than expected. So take us back to, March, April of last year, as, COVID was setting in, and okay, so now we have the news of COVID, and the market took an initial, negative reaction, down 20, 30%. But what is it looking like, 6 months, 9 months, 12 months, 18 months out in the future? If that news is expected to be worse, the markets would continue to fall. If, the news is starting to come out no worse than expected, the markets should be stable and, tend to, continue moving back in the positive direction. But then if markets, or I should say if the news is even better, as we saw, as the vaccine was created and the efficacy was really high and people started getting vaccinated, all of a sudden the news is turning. And so then we should expect the market to rise because the news is better than we initially expected. And so, it's really the reason why in March and April of 2020, there was a lot of bad news out there. There was a lot of, bad stuff going on, but the market didn't continue downward. The market recovered, and quite swiftly, in fact, moving back up in April and May.
That's a great segue to the next slide, Joe, right?
Because markets are forward-looking, and it's the surprises that matter. And if you listen to, again, some of the talking heads, but, even on the news nightly, they'll talk about earnings surprises. So, a company like Microsoft or Apple has to, announce their quarterly earnings or what the analysts expect the earnings to be. And then it's that surprise. If the earnings are a lot worse or a lot better than what was expected, that causes the stock price to go up or down. But you have to remember that by definition, a surprise is something that you don't know ahead of time.
Yep.
So how do you even plan for a surprise? You can't. I mean, that's the crazy thing. And of course, happy surprises are just as probable as unhappy surprises. It's like flipping a coin. It can go either way. And so you can't get wrapped around, people that are trying to decide ahead of time, is that surprise going to be good or is that surprise going to be bad?
Yep.
Because
Yeah, it reminds me back to the 08-09 once again, because I think everyone when things were really at its kind of worst situation, almost all the prognosticators were saying we're headed back to the Great Depression 2.0. Yep. We're going to be in a depression.
Yep.
And then when the market started to turn, it was when we started to realize, what, we're not going into a depression. The news wasn't getting as bad as we had anticipated as going into a depression. And then all of a sudden markets had, a huge recovery coming out of that 09 timeframe. And so, that I think is critical in terms of what Buffett's mindset is, it's all about, we know there's going to be good news, there's going to be bad news. Is the news better or worse than what we anticipated?
Right. And you also have to kind of separate, the economy from the stock market. And so the economy had troubles during the pandemic. The stock market, continued moving up because the companies that make up the stock market, which are the large publicly traded companies, very, very few of them went out of business. The companies that went out of business were the mom and pops that are not traded stocks. And people were still buying at Starbucks, at Target, at Amazon, at Apple, and Microsoft. And those products were still being sold. They were still earning profits, and therefore the stock prices continue to go up. And so that's, you have to separate.
It's that old expression of, volatility creates opportunity. And the volatility that was out in our lives and in the stock market allowed companies to adapt and thrive, through all of that. And really there were a lot of people hurting, no doubt about that. But there was also a lot of people that were redirecting their resources because they're not spending, $5,000 on vacation this year because they're stuck in their house. Well, let's spend $5,000 remodeling our bathroom, right? And so there are things like that happening out there where people are still spending money. They're just spending it in different places.
Yep. Home Depot and Lowe's stock took off because of that exact thing. And so, then Buffett kind of chimes in with the avoid stage one thinking. And, stage one thinking is the reactive thinking. It's the, you hear something happens and your gut says, oh my God, this is bad. I'm going to bail out. And so Buffett instead tries to engage in what's called stage two thinking. And stage two thinking simply is asking that next question, which is, okay, something bad happened. What happens next? And then make a decision based on that second stage of the process, not just on the initial news of the bad event. And so, when you look at, the what next, the things, for instance, like what will the government do? The government was really proactive during the pandemic, as opposed to the 2008 financial crisis of being, out there in front, getting money into people's pockets, working on the vaccine, and trying to make things work as quickly, as efficiently as possible. So obviously, as we touched on the last thing, do I know something different that the market doesn't know? And, I think, we certainly believe the answer is no. There are obviously some insiders that have a little bit different information than the market as a whole, but that's why there are, rules against insider trading. Does the current prices in the market reflect all the news that's out there? And again, generally the answer is yes. And so if you're reacting to the current news, that's already priced into the market. What you're watching on the TV at night is not changing tomorrow's stock market price. It already changed today's stock market price. Do I want to sell when valuations are low? Or do I want to wait and get higher expected returns? When I reacted to such events in the past, what were the outcomes? And then simply, if I sell in a crisis, how will I know when it's safe to buy back in? We already talked about this. You have to be right twice. You have to be right that it's the decision to get out, and then you have to be right on the decision of when to get back in. And that typically is the more difficult decision to make.
Yeah,
I want to touch on one real quick on the when valuations are low and expected returns are high. This goes both ways. We just came off of a huge recovery coming out of that pandemic. And as you guys know, we have an investment committee that meets on a regular basis, and every year they come out with their capital market assumptions for what they see moving forward. And when you have an asset class like, let's call it large cap growth, that consists of like the Microsoft, Amazons, Facebooks, Teslas of the world, these growth companies have had outsized returns for a period of time. And so when you start to have conversations with folks that then begin to expect that those returns can be consistent, well, it doesn't work like that. When you have valuations that are high, expected returns become lower. When valuations are low because you've had a huge sell-off, expected returns are higher. And that's something that I think Buffett would always say is just one of the big, simple things to always remember when it comes to how you invest moving forward.
Yep. And of course, all of this comes down to temperament, right? And this is pretty funny. Once you have ordinary intelligence, what you need is the temperament to control the urges that get people into trouble in investing or in anything else in life, right? So in other words, it's simple to invest like Buffett, but you just need a well thought out plan. And more importantly, you got to have discipline. You got to have discipline to stick to the plan. And that's probably one of the most challenging things for folks. I just got an email yesterday from a client. Hey, Ari, what should we do with things are kind of crazy. It feels kind of crazy in the world. Should we change our investment philosophy? Should we change our portfolio model? And, the answer is, well, what's going on in your life? Do you still need to get a check every month? Or have your income goals changed? Has your retirement timeline changed? Has there been a change in your health or your marital status? Have you bought your home, sold your home? These are the questions to ask when it comes to, the investment plan, right? And it's all about temperament and just making sure that you don't let your emotions drive your decision process, that you just look at the fundamentals.
And I think, let me say something on that, Ari, because I think this is really a good time to interject this. But, I think when it comes down to is if you have trouble with temperament, right, which, we run into a lot of folks that tend to have trouble with temperament. And I'll never forget about a year ago, at the beginning of the pandemic time frame, I remember talking to one of my best friends from high school. And I asked him, I said, have you been following everything on the news with the pandemic and everything? And then we were talking about some other things that were newsworthy as well. And he goes, I'm not really sure what's going on, to be honest with you, Josh. I stopped watching the news about 6 months ago. He's like, I'm the happiest I've ever been in my life.
Oh, yeah.
And I said, wow. Yeah. And as I thought about it, I'm like, yeah, it's probably a pretty good thing for everybody to consider, is to not allow all that noise and distraction cause you to potentially have these urges to want to feel like you have to do something. And I think that there's so much bad news out there. I think I was on Twitter earlier and somebody tweeted, I just dropped my Apple News subscription because it makes me depressed. And then Elon Musk tweeted back, he goes, I did the same.
Yeah.
And so, it's all that stuff, the noise that really impacts you. We call it the noise anyway, that kind of keeps you from sticking and staying disciplined to that plan.
Yeah. Like anything else, it's, your emotions are driven by what you consume. And if you're consuming too much news, it's probably not a good thing, right? I mean, as one of my friends once said, when you're walking down the street, you got two choices. You can look at all the cigarette butts that are sitting in the gutter, and that can bring you down, or you can look up and see all the beautiful trees around you, and that might lift you up. So, where are you putting your energy is really important. And in terms of the topic at hand, right? Having a system, having an investment plan, and sticking with it is really important as well, right? One of the things that we look at doing for our clients is getting a proper asset allocation in place. It's based on their willingness to take risk. It's based on their goals, their objectives, their time horizons, et cetera, right? And what we try to encourage our clients to do is, don't act on forecasts. Don't try to time the market, because we know it doesn't work. Give up the hope of outperformance, because the winners do rotate. Have a broadly diversified portfolio, right? We just talked on this topic, right, which is hit the mute button once in a while, right, and turn off the news, and generally speaking, for the most part, we're relatively passive in that we're not jumping from one area to the other. It's not like international is a good place to be in today. It's not going to be a good place tomorrow, and it might be better next week, right? We want to have a consistent strategy. All that being said, some people need to scratch the itch once in a while, right, Josh?
Absolutely. And we tell people that, it's like, especially in a year like this past year where, you all the meme stocks and cryptocurrency and all these things that have had these ridiculous returns. And we say, just like, I don't mind going to Vegas every once in a while and playing a little blackjack and enjoy that. And it's gambling. I go there with a set amount of money that I'm willing to lose. And if I happen to come home with none of that money back in my pocket, I've accepted that before I even showed up. Mm-hmm. Having a play account from an investment standpoint is okay too, as long as you realize this is not the money I'm going to live off of someday and retire. This is money that I'm willing to take a risk with, that, hey, maybe I hit a home run and it's very successful, but if it's not, I'm willing to lose that portion of the money. And so, we oftentimes will have folks that say, hey, I want to have a little play account, and that's okay.
But you have to look at it. You have to look at it just like gambling, as entertainment. As
Yeah.
long as you say, hey, this is my entertainment, I'm going to take, $100 and, play blackjack. And when it's gone, I'm done. And if it goes up, I'll continue playing. That's just, for entertainment purposes. The same with, having a trading account. As long as you look at it as, hey, this is my entertainment, that's fine.
The other thing with that's really interesting on some folks, they have huge gains on stocks. I mean, let's be honest, right? I mean, there's some folks out there that are sitting on huge gains in stocks. And then the conversation always shifts to, well, I can't sell any of that stuff. I'm going to get creamed in taxes. And then they go, oh, man, I wish I would have. Then, eventually the stocks, pull back a little bit and go, man, I should have sold it back then. I would have made so much money. So there's another behavioral aspect as well to that, So
I'll just say one last thing on this slide, and I'll move on to, kind of summarizing what we've discussed so far. But, giving up the hope of outperforming by investing with the latest hot fund manager, I think that's, one I just wanted to stress, because if you go back, guys, as you know, the beginning of our careers, we all thought that was the answer in terms of, oh, if we could just find the best performing mutual fund or the hot fund, then we will show all these great, outperformance returns for our clients. But the reality and what the evidence has always shown is that hot fund manager doesn't stay hot for long. It's not consistent. And so the evidence says that the average active hot fund manager tends to underperform the market over time. And it's not the same managers every year. And that's the challenge of trying to pick those folks. And so certainly if that was something that was easy to do, we'd all be looking for that hot fund manager and making sure we rotated to that.
All right.
So I want to just kind of summarize some thoughts in terms of, if you want to invest like Buffett, here is kind of the summary of things that he points out. Using a passive evidence-based investment strategy. And as Ari said, it's passive in the sense only that we're not sitting there and trying to get in and out and in and out and in and out and not trying to overly trade the account, which I told you causes a lot of friction and costs. Evidence-based is extremely important. And for all those that have worked with us over the years, we use 80 plus years of academic research that goes into how we build out our thoughts and strategies around our investment allocations. Tune out all the economic and market forecasts. I think we hit that pretty hard. Don't try to time the movements of the markets. Buffett's very big on that. Develop a written investment policy statement based on your need, ability, and willingness to take risk. Ari hit on this earlier. We sit down with every one of our clients and talk about what is this money for? And I can't tell you how many times I've gone out to a party or something and people find out, that I'm in the investment business and say, oh, what should I be investing in, Josh? And I say, I have no idea what you should be investing in. I have no idea what your situation is or what you're trying to accomplish. You got to have goals first, and then we try to match it up with the willingness you are to take risk, and then we try to develop that plan. And then you need to control your emotions and stick to the plan, right? Maintain discipline, as we hit on. It's very difficult to do. It sounds easy, but when you're in the midst of a free-falling market or a chaos or crisis, that's going on, it makes it very challenging to stay disciplined to that plan. We're very emotional about our money. And then obviously it makes sense to review your plan whenever, as Ari said, anything big changes in your life. Not only are we rebalancing it regularly, but any widespread changes have to, be based off of something that's changed around the goals or objectives or level of risk that you're taking. So I think that, what I'm really trying to say is that the winning strategy is to really focus on the things that you can actually control. I think a lot of times in what we do, guys, is, people try to focus on things they can't control, like, the market going up and down, or whether or not the COVID-19 is spreading, again. These are things we can't really control. We have to focus on those that we can, and the things we've talked about today are those things. And I think the other part that I think what we've made it sound, guys, before I continue here, is it's really easy. It sounds really easy in all that we're talking about, but in practice, it's really not as easy as it sounds.
And that's exactly where we come into play. And as this kind of shows that intersection between your money and your life is where we play a role in your life, being able to provide that financial advice of not only how to invest to reach your goals and how to invest to get returns, but how to invest as things change over time and how to react or not react to those inevitable market ups and downs. And so, question we often get is, well, if my time horizon is only 5 years, should I be investing differently? And the answer is obviously yes. You would have a different investment, portfolio, a different IPS for a short-term goal versus a long-term goal. But everybody has longer-term goals, and often, probably the biggest thing that we hear is, well, I'm only going to live to age 75, and so let's just plan to age 75. Well, what if you're wrong? What if you live to 80? What if you live to 85, to 90, to 95? People are living a lot longer and longer. And so your investment plan really needs to have at least a component of a lot longer time frame. And so everybody has some proportion of stocks, bonds, cash in their portfolio based on the risk tolerance and how long their goals are. And that's the real financial advice. It's not just simply saying, yeah, let's throw all the money in stocks or let's throw all the money in bonds and get what we get. It's trying to figure out how your money and your life integrate together and meet that intersection.
Yep. The other thing as well is and this is another question we had is around the experience of investing often changes the temperament that a client may have. Meaning the better educated a client becomes on the investment process, the more risk they're typically willing to take because they have an understanding, right, about the upside potential or the downside risk on a portfolio. And that's why we do reviews with clients and we go through their investment plan and revisit it and say, hey, how are you feeling about this? We went through a down cycle. Were you sleeping okay? You have another 20 years. You're going to live another 20 plus years. Do you want to turn the heat up a little bit or does the pace feel comfortable? Here's our recommendation. How do you feel about it, right? And that's just part of that consultative process of providing financial advice.
And part of that goes into portfolio design as well. And we believe very strongly in taking risks that are worth taking. There's a lot more risks in stock investing than the ones that we involve in. So we look specifically at those statistical facts that have been proven over a long period of time that, for instance, stocks have a higher return than bonds over a long period of time. So it's worth taking that risk of investing at least some of your money in stocks to get that higher return.
Yep.
Growth stocks versus value stocks, large versus small. There's so many international versus US, so many different factors. And so we try to take the ones that will actually reward you for the risk you're taking and not blindly taking risk that doesn't necessarily reward you long term.
Yep. So,
a couple questions came in that I think we should make sure we address before we get to the kind of conclusion. One was, the question said, is the recommendation to invest as Buffett recommends, not necessarily like he actually does? And the answer there is yes, because even Buffett himself would tell you that. He obviously invests in big chunks in individual companies, but the idea is that we don't have, all of us, including all of the people on the line, are not Warren Buffett's, right? And so what he is basically recommending is, as we've just suggested, that you should be investing in broad market exposure, not necessarily buying as he does. So yes, that's the answer. Not to invest as he does, but as he recommends you do. Any additional to that, guys?
No, I think you covered it pretty good. I mean, it's very client specific in regards to the composition in the portfolios. So I think we've gone over that.
Well, I'll just follow up with Berkshire Hathaway, Warren Buffett's main fund, because it is actually a fund. It has multiple different companies in it. Would not fit our investment philosophy because it's actually too narrowly constructed. Our investment philosophy is a little broader than that, of buying the entire U.S. stock market, all of large cap, all of small cap, And so, we're not saying go out and buy Berkshire Hathaway, but it could be a component in your overall portfolio, your overall plan.
Another question was regarding market. I think Ari mentioned that the market, or Joe mentioned that the market has corrections every, certain period of time, 5 to 7 years. We typically have a recession maybe every 5 to 7 years, and we are going to experience, and during recessionary times, big drops in the market. And so, if someone feels like their time horizon is much shorter, should they change their investment plan? I think that is specific by client. But I think, a lot of times people say, well, Josh, I'm retiring next year, so I need to get super conservative. And maybe they're only 64 years old and their life expectancy is, mid 80s to 90s. So what their true time horizon is maybe another 20 to 30 years left of living.
Yeah.
And so too often folks look at their time horizon as being when they make this big monumental move into retirement, but you still have to be able to get a return on your money even in retirement to be able to keep up with inflation. And that's been a hot topic lately, is that inflation's on the rise. And so I think the key with that is truly understanding what your time horizon is, and then making sure that you have enough in there to, in the risk assets like stocks, to make sure that you can, one, sleep well at night, but also two, keep up with inflation and achieve the goal that you have of providing retirement income for you.
The other comment I'll add is also making sure, if you are in a distribution mode and taking a check out of your account on a regular basis, that there is enough cash or fixed income runway, I call it, to maintain your income flow, right? Because the markets will go down and eventually they'll come back up, and you just want to make sure that you have enough cash runway, as I like to say, to fund the projected expenses, throughout a recessionary environment. And the other part is that the realistic part is, as advisors, if you say, hey, if we're in a recession and you say, hey, we want to take 20 grand out and go do that tour, that African safari, we'll probably say, you might want to put that off a year if it makes sense to, or yeah, you have plenty, go for it. So we do have that, we're not shy about mentioning that either.
And then the last question, as an investor goes from naive to informed, and their approach will inevitably change in terms of risk, does PWA have a deliberate intent to adjust? And I think Ari kind of hit on that in regards to reviews. When someone first becomes an investor or starts to really understand, kind of how they're getting into this whole thing of investing with a plan, they may at that initial stage not really know exactly how much risk they should be taking, and then as they get more comfortable, maybe they're 2, 3, 4, 5 years in, and they're starting to realize how the process works. They realize maybe I was being too conservative, or maybe after this big pullback, I realized, that's more risk than I was comfortable with. That's when we would look at, okay, let's maybe, change the plan a little bit now that you're more comfortable, more informed, more sophisticated, whatever the word is. But that's what the reviews are for, is to kind of revisit that and make sure that it's as comfortable as you are in terms of what you're trying to accomplish.
We're coming up on the 1 o'clock hour, and we wanted just to remind everyone that we do offer a second opinion service for your friends, families, colleagues, etc. So if there's someone that's maybe they're second guessing the investment advice they're receiving, or they need a little bit of guidance, we have a pretty simple process to provide them a second opinion on how their accounts might be structured. And we do a discovery meeting, a phone call, and then go through their documents and provide them some feedback. So there's no charge for this service. It's just something that we offer. We feel that it's just something that's important that people know that it's available to. So, and then we're out on social media, Facebook, Instagram. We're still doing Instagram, guys. YouTube. We're in the midst of redoing our website, so that'll be launching here probably in the next few months. But we want to thank everyone for attending, and hopefully we provided some feedback that is worthwhile. Appreciate all the questions as well. Did we miss anything?
I think we hit it pretty good, guys. I mean, I think this is, we wanted to have a little bit of fun with this one. The Oracle of Omaha, the most famous investor of all time, Warren Buffett. Obviously, he's a billionaire and one of the richest men in the country. And so we thought it'd be fun to kind of talk a little bit about his approach. Hopefully, you all enjoyed it. We have a webinar coming up next month on, I think we're going to cover Medicare. Dates and times and so forth are coming out shortly. And yeah, just want to say thank you to all who attended. Guys, thank you.
Yep,
and
thank you.
Until next time, we will go ahead and close it up. And this
All right.
will be recorded, so if you need a copy of it, let us know.
It'll be on the website within a week, I think, too.
All right.
Very good.
Bye-bye.